Hi, I'm Magnus, CEO of CEEZER, and I wish you a happy new year 25. We're coming out of a pretty interesting time in the carbon markets in 24. We saw pretty steady retirement volumes, but an increase in value. Today we're going to talk about what that means for buyers in 25. We basically look at four main trends. The first is this shift to value will continue. We saw on platform that the average portfolio on CEEZER increased by over 85% in value, meaning that companies are investing increasingly on the higher end of the market. So for companies deciding to engage in the voluntary carbon market in 25, that means you will need to focus even more on quality, but make sure that you get your investment worth of climate impact. And it's developments like having better and live digital MRV that can really help make that case, both internally but also externally. The second point leading to an increase in value was the continued shift to carbon removal. We saw over 300% year-on-year increase in CDR investment, but more notably, we saw a continued and steady increase of carbon removal in average and more mixed portfolios. So it really has started to hit the masses, and it moved away from just a few landmark deals. There's two things that are important in 25. First, the more accessible removal technologies like nature-based solutions or soil enhancement are getting increasingly scarce when you look at the well-rated and high-quality projects. That means that buyers need to enter now and secure supply for multiple years. That's practically the only way to secure that you will have access to those credits over the next years. On the higher and more technological end of the market, we saw prices actually coming down, and we continue to see them coming down. And that is because technological solutions are maturing on a technological level, but also the scale is starting to hit the price. That means that buyers now have permanent removal credits available for well under $100 per ton and can integrate those much more easily into portfolios, even under budget constraints. The third thing that we're really excited about is the increasing number of primary market participants. So in 24, we estimate around 5,000 entities being active in the market. That's more than in the years before. And we continue to see that trend happening. One driver for this is certainly the huge challenge of Scope 3. Enterprises are reporting more and more that achieving Scope 3 targets is not going as planned, many are delayed, and the role of carbon markets is increasingly important. Many companies are reporting that Scope 3 target achievement is delayed and that this process takes way longer than expected. Carbon markets can play a crucial role in either compensating for a delay or also be a complementary measure to secure achievement of Scope 3 targets. What's exciting is that the tooling is now available to really collaborate easily with suppliers. So buyers can actually offer a lot of value to suppliers by offering easy access to the market. Tools like CEEZER can make this incredibly seamless and really risk mitigated. But that development is also driven by progress on the frameworks and policy guidance. While 24 was probably a bit stalling in terms of Scope 3 engagement, what role will carbon markets play, we're expecting 25 to offer a lot more clarity to buyers. Notably, we're looking at two things. First, BCMI's Claims Code of Practice for Scope 3. We expect the guidance to come out early 2025. And our expectation is that the role of carbon markets will be much clearer than in other frameworks. More looking ahead, we're also looking forward to a potential update on the net zero standard of SBTI, where again, the role of carbon credits will be clarified potentially. On the policy side, we saw progress in Article 6.4, and many buyers are starting to ask questions. What does it mean for us? Should we move fully to Article 6.4 compliant credits? We honestly expect a lot of the questions to remain unanswered throughout the next year, as a lot of the details aren't yet developed or figured out on policy level. At the same time, we do see that both buyers and sellers are starting to adapt. We have buyers asking more and more for credits with corresponding adjustment, and we do see a steadily growing pool of supply that can already deliver letters of authorization, which are the prerequisite for a corresponding adjustment by the host country under Article 6.4. The one thing that's important to keep in mind is that a letter of authorization at this point does not really help with quality. The quality standards set out under the Paris Agreement for Article 6.4 are relatively high level. There's no metric-based approach to this, which means that buyers will be even more careful in selecting high quality and risk mitigated projects if they pay a premium for this. To sum it up, exciting things ahead. For those buyers that are already in the market, I think a lot of great availability and tooling out there to enhance your footprint, to engage with suppliers, to really like leverage collaboration to drive this forward. And for those who are looking to enter the market, it's a great time to get engaged and to get started with a lot of support in place and a lot of infrastructure ready to help you where you are to make sure that your investment hits the maximum client impact. And with that in mind, looking forward to an amazing year, looking forward to a lot of great conversations, and looking forward to talking to you about how you can leverage carbon markets to accelerate your climate journey.